Atsi Sheth, Vice President, Senior Analyst, Sovereign Risk Group at Moody's, joins us with her latest report. Good morning, Atsi. Thank you very much for joining us. I believe you have braved the rains in Singapore to get to our studio. Thank you very much for that. An upgrade of 5.1% from Moody's is always pleasant, but our poll is throwing up an average of almost 5.9%, with quite a few people sitting at 6% for the Q1 itself. Why are you so moderate?
You know, the common thread between our fairly conservative forecast and the numbers that you've just quoted is that this is a turnaround in growth, that growth is going to be significantly higher in the first quarter of this fiscal year compared to the last quarter of the last fiscal year. And I think that's the common thread. As to why our number is a little bit more conservative, I think it takes the risks into account, the risk that the agricultural output, even though this is a pre-monsoon data, of course, this is April to June, that the agricultural output might be a little bit subdued, and services output, there's some uncertainty there. I think we're all agreed that industrial output will show the most pickup compared to its past performance, but on services and agriculture, we're a little bit more conservative.
Atsi, hi, good morning. Thank you for joining us. So if you can just give us more numbers on the agri output itself. When you say subdued, what do you mean? Because our poll is throwing up a growth of 2.8% in the agri division. What are you expecting this time?
We're a little bit lower than that. We think it'll be about 2%. But again, I don't think the 2.8% number is too optimistic. It could come out, you know, closer to that. And certainly we see a little bit more upside on the agricultural side. Again, these are all pre-monsoon numbers, so I don't think the monsoon performance will affect them at all.
Okay. Well, from a rating agency, the concern more is, I assume, with fiscal deficits or other deficits in general. So let me turn around to those questions. Atsi, one big positive or tailwind for this economy has been the fall in crude prices. Are you now more confident of that 4.1% fiscal deficit number that the budget threw up?
I think a couple of things, including the crude oil prices, will affect that 4.1%, and certainly all those things are positive. One is, yes, if oil prices remain at current levels and fall further even, that would benefit the budget expenditure side, certainly. The other is the exchange rate staying either fairly stable or, as some expect, even appreciating a little bit. That will also benefit the budget. And then the most important, I think, is this turnaround in growth, because if we do see growth turning around, we're likely to see revenues also bouncing up, and that'll again affect the way the budget pans out. So yes, all three trends are in a positive direction.
So now, since you're pointing three tailwinds where I pointed only one, should we understand that this government or the Indian bonds could be on the cusp of a rating upgrade?
You know, all the three things that I pointed to were not beyond our expectations. I mean, you remember, Lata and Sonia, we've talked about this over the last several months, and we were among those who felt that India was poised for a cyclical upturn. Now, nobody could predict when that would happen, but the reason the rating outlook on the Baa3 rating stayed stable was we were expecting exactly this. We were expecting growth to turn up, and we were expecting the fiscal to benefit. So our stable outlook really anticipated what is being seen as good news now.
Can you give us some idea as to when you expect a rating upgrade? What factors would you watch out for, and would you have any timeline?
Absolutely. I think that's a good question. At this point, we're really seeing three constraints on India's rating at the Baa3 level. The first one is the fiscal, which we've already talked about. But I want to say that even though, you know, the fiscal targets keep becoming narrow and narrow in terms of the deficit, India's deficit is still much higher than other countries rated at the Baa3 level. Its debt level is much higher than comparable emerging markets. So that's one thing. If those numbers start trending down, I think that there could be positive momentum on the rating. The other constraint is, of course, inflation. And here I think the jury is still out. The trends have been, you know, inflation has been declining in headline terms, but food inflation has been sticky, and it'll probably still be sticky this year given the monsoon performance. So that's the other factor that we would consider in looking at the rating. And the third, we've always said that, look, India's infrastructure poses constraints to its potential growth, that India's potential growth could be much higher than even the 6 to 7% people feel that this cycle will yield if infrastructure constraints are addressed. So if that was something that we saw evolving, that would be another positive factor. In terms of time frame, we think this government has made several announcements that address all of these three aspects, but we're not seeing results yet. So it's when the results start showing up that we would think about changing our view on the rating.
Okay. Within your estimate for the number today, what is your view on how industries will grow? Because the poll that we have done throws up a 4.1% growth on the industry side, led purely by manufacturing. What's your view on how much things have picked up there?
You know, based on the IIP data and the PMI data, we think somewhere between 3 and 4% is probably likely. Sometimes the GDP, the way the accounting is done, the GDP numbers come out a little bit different than what the IIP numbers yield, and I think your poll seems to discount that a little bit, that those numbers are higher. But we think definitely compared to industrial performance last year, where it was very low, even 3% and a little bit higher than that is a fairly robust turnaround in industry.
Okay, finally, Atsi, what's the take on the currency? There could be one bump, perhaps, when the US rates are raised. But fundamentally, how are you looking at current account deficit and the currency?
The current account deficit, Lata, we think it will widen a little bit. It had narrowed substantially towards the end of the last fiscal year, and that narrowing had to do with two factors. One was the currency depreciation itself, which, you know, disincentivized imports and incentivized exports. That was one thing. And the other was that growth itself. Domestic demand was fairly low during the second half of last year. And thirdly, you know, somewhat relatedly, global export demand was a little bit higher. So I think those factors contributed to the current account deficit narrowing so much. Now, as import demand picks up, as growth solidifies in India, we're expecting imports to look up a little bit. The currency is certainly not depreciated anymore, so there won't be that boost to exports. And global geopolitics and global growth concerns are re-emerging, so that may dampen exports a little bit. So we think the current account deficit may widen. We think it will remain manageable. It will be amply funded by direct investment and portfolio flows that are coming in now, and some of the borrowing that Indian corporates are doing. So we do think that even though the current account will widen in terms of the deficit, the balance of payments will likely be in surplus, leading to a buildup of reserves. Given that scenario, I think the sort of potential for the rupee is slightly skewed to the upside rather than the downside at this time, which is very different from about a year ago.
Just two numbers.
Even given further tightening.
Just two numbers, FY15 GDP and FY16 GDP forecast?
Sure. We are at 5 and 5.5%, and we think there's upside risk to that given how momentum pans out this year. Those numbers do take into account geopolitical and global growth risks.
Fair enough. We'll leave it at that. Atsi, always a pleasure speaking with you. Thank you very much for joining us today, the penultimate day before the Q1 GDP numbers are announced today.